Employee Benefit Plans Industry Update was a live webinar that was originally produced on Thursday, November 21st, 2019. For this webinar, we were joined by Dan Sturm, Partner and Director of ERISA Services here at McKonly Asbury, along with Danielle Guinter, Principal and Leader in McKonly Asbury's Assurance and Advisory Practice. We also welcomed Renee Lieux, member of McNees Employee Benefits and Executive Compensation Group. We hope you enjoy this recap, and please visit us online at macpas.com for more information about our future webinars and other events.
Hi, welcome to the Employee Benefit Plan Industry Update Conference. My name is Dan Sturm. I'm a partner with McKonly Asbury, and I'm the director of the ERISA Services practice. I also assist with the construction practice, insurance practice, and the Federal Acquisition Regulation indirect cost audits.
Hi, my name is Danielle Guinter. I've been with McKonly Asbury for about 14 years now. I'm a principal in the audit segment, and I specialize with employee benefit plan audits as well as for-profit audits for manufacturing clients.
And hi, my name is Renee Lieux. I'm an attorney with McNees Wallace Nurick in Harrisburg, and I practice in the Employee Benefits and the Executive Compensation Group.
Welcome to the conference, and thank you for joining us today. We're appreciative you took some time out of your day to listen to us today. We do want to start off with a polling question. This is just for us to understand who our audience is and make sure we kind of gear some of our questions and some of our comments to make sure we're covering all those in the audience. So the first polling question: what role do you play as it relates to employee benefit plans, human resources, finance, plan service provider, or other? And we'll give you a couple minutes to make those responses. All right, about the mix we expected. So we have a good mix of finance professionals on the line. We also have some human resource professionals. Looks like we have a couple service providers as well, and a mix of some others as well. With that, lead to the overview of the webinar. So what we want to do, we want to spend a couple minutes talking about an accounting update. So we'll spend a couple minutes going through some updates from the accounting side of things. We want to look at some best practices as a plan sponsor, maintaining compliance with ERISA. We also want to get into some cybersecurity considerations, especially as they relate to benefit plans. We want to talk about a legal update, which McNees is here to present for you. And we also lastly want to finish up with some recent ERISA court cases and some lessons learned with that. And with that, I'm going to kick it over to Danielle to talk about the accounting update.
So by far, this first auditing standard that I'm going to talk about is probably the most significant one. However, before I get into the details of it, I wanted to give a little bit of a background on why it was considered necessary. So essentially in 2015, the Department of Labor did an audit quality study. And as a result of that study, they concluded that out of all of the audits that they looked at, 39% of them were deficient. So needless to say, the Department of Labor wasn't very happy. So they went to the AICPA and they were basically like, guys, listen, we can't have this. What can you do to help? So that's where SAS 136 comes from. And it is effective for audits for periods ending on or after December 15, 2020. So essentially your 2020 calendar year end audits. And essentially what the auditing standard does is twofold. One, the hope is it will make it more consistent as to what procedures auditors are doing. And two, it really tries to increase the transparency as far as what are auditors' responsibilities versus what are management's responsibilities. And part of how they do that is through the audit report. So right now, your audit report is probably a page and a quarter. After the standard, it's going to be 3 pages long. So again, it's going to be a lot more robust. It's really going to spell out what the auditor's responsibilities are versus management's. The other thing it does is we're all familiar with limited scope audits and that terminology. Well, that goes away. It's now going to be called ERISA Section 103A 3C audits. So a bit of a mouthful. We're going to have to get a little bit used to that. And then there are also a few other new reporting requirements. So the first new one is related to engagement acceptance. And basically what the standard says is that auditors are required as part of the engagement letter process to obtain management's acknowledgement of their responsibilities. So to give you a couple of examples of what that means, management is now going to have to acknowledge that they're responsible for keeping an up-to-date plan document, including any applicable amendments. And then the other one is management is going to acknowledge responsibility in the engagement letter for determining that their plan is permissible to have an ERISA Section 103A 3C audit. Now, the other 4 bullet points that we have here, they say they're new requirements, and Dan, let me know if you disagree. I didn't really think any of these were new. These were things that we've always been doing. However, while we've always been doing it, and there are probably several other auditors out there who have been doing it, obviously not everyone was doing it. It goes back to that 39% deficiency rate.
No, and I think I read the same thing when the new standard came out. I was expecting like a major overhaul to how we looked at things and how we did things and conversations with our clients. But the more we got into it and the more we read things and the more we understood it, I just realized it's a lot of the things we're already doing, which is what they want and what they intended to happen with this new standard. So again, it's things we were already doing. It doesn't change a lot, in my opinion, of how we've served our clients already.
Mm-hmm. And just to give you a few examples, so with the audit risk assessment, essentially what it says there is that if you've determined an audit area is high risk, you're going to want to spend a significant amount of time there. So that's pretty straightforward. As far as communication with those charged with governance, if as a result of an audit procedure, an auditor finds a reportable finding, they are required to communicate that to those charged with governance in writing in a timely manner. As far as procedures for ERISA Section 103A 3C audits, these are pretty straightforward. One, we're required to obtain the certified trust statements and we're required to read them. We're also required to make sure that the information in the audited financial statement is consistent with what's in the certified trust statements. So I don't think any surprises there. And lastly, we're required to receive a Form 5500 with all supplemental schedules before we can issue the report. And we're required to make sure that there's no material difference between the audited financial statements and the 5500. So again, while they call these new requirements, I think you'll find that the majority of them were already being done in the audits. The next accounting update is a lot more straightforward. Accounting Standard Update 2018-13 Fair Value Measurement is effective for years beginning after December 15, 2019, so your 2019 calendar year audits. And essentially, this one does add disclosure requirements, but the good news is they are not required for non-public entities. And the other nice things that it does is it removes some disclosures. So for instance, you're no longer required to disclose the policy of timing of transfers between levels. And my favorite is it takes away the level 3 roll forward. So previously you would have had a level 3 asset, you would have had beginning balances, purchase, sales, unrealized gains, losses. That goes away. Now you only have to disclose the transfers in and out and the purchases and issuances. So makes it a lot more streamlined. And then I think, Dan, you're going to talk to this next standard.
Yeah, so this next ASU 2018-14, I'm not going to spend much time on this. So a lot of our presentation today is more geared from the benefit plan itself perspective. But given this was out here, we wanted to make sure we're at least presenting it to the audience here. So this applies to defined benefit plans, but it's applicable from the sponsor perspective. So it doesn't necessarily impact the benefit plan financial statements. This will be the sponsor financial statements, and this is effective for non-public business entities for years ending after December 15th, 2021. And the key things to note here, there's some additional disclosures required for DB plans, and there's also some removal of disclosures. Probably one of the big additions that I'll highlight on the screen is the second point up here, narrative descriptions of the reasons for significant gains and losses affecting the benefit plan obligation. So just take note of that. If you do have significant gains and losses in your benefit obligations, that you will have to describe that in the notes to your financial statements. Probably the big item for the removal of disclosures is this third point below. This is non-public entities with level 3 plan assets measured on a recurring basis. Reconciliation of opening balances to closing balances is no longer necessary. So again, I don't want to get into too much detail because I don't think that's the purpose of our presentation today, but it is out there. It does relate to defined benefit plans, but more from the plan sponsor perspective.
So since we were speaking about management needing to acknowledge their responsibility related to this new auditing standard, we thought it might be helpful if we provide a few best practices for maintaining ERISA compliance. And the first one we wanted to highlight is your plan document and making sure that you're doing an annual review of it and making sure you have all of the applicable amendments. And don't be afraid to get your service providers involved in this process, whether that's your third-party administrator, your trustee, or your custodian, or even your ERISA attorney. And we're fortunate to have Renee here with us today. So Renee, I don't know if you can give us any examples of maybe some things you might identify when you're reviewing a plan document?
Right. So when we review plan documents for our clients, we look for a couple of different things. One, obviously, is going to be legal compliance. Is the plan document up to date with all the required amendments that the document has to have? Another thing that we look at is whether or not the adoption agreement, the SPD, actually jive. Or are they saying the same thing? And a lot of people don't understand that when they think about your 401k plan document or your benefit plan document, everyone automatically thinks that it's just the SPD. And it's not the SPD. It is actually the 200-page single-space document that nobody ever reads in conjunction with like the 15-page adoption agreement that's a check the box that you have to read them together. So with that in mind, we want to make sure that what the employer thinks the plan says and what the SPD says the plan says is actually what the plan says.
That makes a lot of sense.
And I think from the audit perspective, we've actually come across cases where we've seen things not agree. And so then we go back to our clients and make that same recommendation to consult counsel, other service providers, because as part of the audit, we're seeing things that just kind of aren't making sense and we see it one place and not the other. So that's a good point.
The other item that we wanted to highlight was related to plan compensation. I would say probably 75% of the times that we find an issue in an audit, it's related to plan compensation. And a lot of times it will be if you have a complex definition for your compensation, like if you're taking out overtime and shift differential and bonuses, a lot of times we see a tendency that maybe something wasn't checked right in the payroll. So it's very important to be looking at this, if not on a quarterly basis, then on an annual basis, because while you may think you have everything set up perfectly in your payroll system, things change, people leave. So it's really important not to take that for granted. Also, if you do switch providers, especially payroll providers, make sure that you are looking at that first payroll run to make sure that deferrals are being calculated properly off the right plan compensation. It's a lot easier to fix something if you find it timely than it is to find it through, whether it's through the audit or hopefully never through a Department of Labor audit. The next area that we find a lot of issues are with participant contributions. We'll find this especially if you have a third-party administrator where your participants are going directly to the third-party administrator to change their deferral percentage. And then maybe the payroll person in-house is receiving like a feedback file through email. Again, people go on vacation, feedback files could be missed, then a deferral change is missed. So it's really important to have a detective control in place where maybe you're printing out a deferral change report from the third-party administrator on a quarterly basis and verifying that all of those changes were made properly. Another thing that we're seeing more of is there's actually third-party administrators and payroll providers that will actually, their systems will actually speak. So you can take the manual out of the process and just make that an automatic reconciliation. So that can help prevent a lot of errors.
I think that's probably one of the biggest recommendations up there, Danielle, because it just goes so far. To your point, people take vacations, people take off. Somebody misses an email with a deferral change. And as you know, if sponsors aren't making deferral changes on a timely basis and something's missed, sponsor may be on the hook and owe the participants some money. So it's a real dollar impact. And with systems and technology the way they are now, I'd fully take advantage of these integrations. I know from speaking with clients and with our own firm directly and dealing with our own service providers, these are not costly initiatives. I mean, they're what I consider relatively reasonable costs to have your systems between your record keepers and your payroll providers speak. There's a lot of opportunity out there to take away a lot of process and manual effort.
And the last one on the slide that we just wanted to highlight is making sure you have a process in place to make sure that your remittances are being done timely. So the Department of Labor says that remittances need to be made as soon as administratively possible, but no longer than 15 business days in the following month. Now that 15 business days, though, is not a safe harbor. So if you can show that you can remit contributions within 2 days, you should be remitting contributions always within 2 days. So making sure that you have some type of process that's tracking that.
And it's probably, back to that point, it's probably one of our most consistent findings I think we see across most audits. And it's not that there's major problems, but it might be a few days here and there that a sponsor might be late. Again, you may have a small client that has a limited department or a limited amount of personnel. And so people go on vacation and all of a sudden it takes a week where it normally takes a day to process the payroll. So I think it's important just to make sure you have processes in place to address that, because I can tell you, and we've had this conversation so many times, the correction process, quite honestly, can be very time consuming depending on the volume of people you have in your plan. And the correction itself is not going to be that large. So ultimately, you spend a lot of time for what ultimately ends up being a few dollar correction, but in our opinion, that correction is necessary. So it's it's not as much the cost as it is the hours to invest to make the corrections.
And the next item that we have are related to service providers, and we've already spoke about the importance of making sure that you're reviewing your service agreements. The one thing that we didn't mention is it's a great idea to get the annual SOC report that your third-party administrator or your trustee or custodian is getting on an annual basis. I think this is important no matter what type of agreement you have with your third-party administrator, but it's especially important if you have a relationship where participants are going directly to the third-party administrator and you're not signing off on distributions or loans. This is the one way you can easily monitor if the key controls at your service provider are working. So I recommend definitely getting that and reading it every year. We also recommend having a retirement plan committee and making sure that you have people from both finance and human resources, that you're meeting regularly, quarterly, semi-annually, and that you are taking minutes when you are meeting. This is a great way to show that you're meeting your fiduciary responsibility if you were ever to be audited by the IRS or the Department of Labor.
Yeah, no, I think the minutes are a very important point up there, because I know a lot of meetings happen at our clients and they talk about their plan and they sit down and they meet with their advisors. But I don't know how often minutes are necessarily taken and maintained. And that's, as Danielle pointed out, a very important part of showing your fiduciary responsibility, that you did have those discussions, that you did consider the investments you're putting in your plan, that you did consider your service providers and things like that. So the only way you're going to be able to prove that is through documentation and minutes. With that leads to our next polling question. Does your cybersecurity policy cover your employee benefit plans? Yes, no, or you're not sure? And we'll give you a minute to respond to that question. All right, looks like we have our results, and looks like most of our audience is not sure. And that's probably the answer I would expect to hear, just because I think not very often, I think a lot of the organizations, especially for those on the call or on the webinar, know they have a cybersecurity policy, but specifically, does it cover the benefit plans? That's where the question comes in. And again, I think that's consistent with what we've seen before this presentation and our expectation. So with that, I do want to talk a little bit about cybersecurity and benefit plans. So why are we even talking about it? And so the first point is benefit plans are very attractive targets for cybersecurity risks. And the reason that is, we see it with our population of plans, and we're working with a lot of closely held family businesses, but we have plans that range from I'll say a few $100,000 in assets to several $100 million in assets. So there's a lot of money involved with these plans. Not only is there a lot of money involved with the plan assets, there's a ton of sensitive participant information that's exchanged within your organizations, and a lot of that information, because the amount of service providers involved, a lot of that information is being shared outside the organization. So there's a lot of sensitive participant information, social security numbers, dates of birth, basically everything someone would look for in a cybersecurity attack to gather that information they want. not only are you sharing information between your service providers, but your third-party service organizations may also share information with other organizations that they work with. And so there's risks with all this information and the amount of volume of data that's going back and forth. As we observed in the results of our quick survey, our quick polling question here, benefit plans are often not covered in a sponsor's cybersecurity planning. That's not uncommon. I think as it gets more attention, and the DOL has given this a lot of attention, so I would expect a lot more attention over cybersecurity and different policies and requirements, probably from the DOL in the next few years, just because of the amount of information that's floating around out there. So I think in some sense, as this last point indicates, sponsors may have a false sense of security with service organizations. So you just automatically think everything's okay. You're working with a great organization, great reputation, but I think it gets back to really understanding where the data is going and how it's flowing back and forth. There are significant consequences beyond just the loss of plan assets as the first point up here. You have reputational cost to a plan sponsor. Think about all the participants. If you have a plan with thousands of participants and data is lost or is subject to an attack, you have reputational costs. So does the service providers, the organization. So there's significant risk. You have operational disruptions. We talk about fixing things like, previously about fixing things like late deferrals or late remittances. I can't imagine the time that would be invested if all of a sudden there was a cyber attack on something related to your plan. So you're talking a lot of resources to fix corrections, deal with service providers, maybe possibly restore plan assets. So things like that, you have significant disruptions to deal with. Lastly, you also have HIPAA violations. So if you're dealing with a health and welfare plan, you have a lot of information, health records possibly going back and forth, making sure that that information is secure. So beyond just social security numbers, now you have actual health records being shared potentially just in an Excel file. So you may have an Excel file with a lot of health claims data going back and forth over email.
And I'm going to jump in.
No, go for it.
If you don't mind. A lot of you may be sitting there thinking, well, we're okay because we use a third-party provider as a custodian, and we have a contract with them, and they are the ones who would be responsible if there's a loss of plan assets because of a cybersecurity attack. And that's not necessarily true. One, going back to what was mentioned earlier, you need to look at your service agreement with your provider, because they may actually have a provision in there to where you would have to indemnify them if a participant sues that third party for loss of plan assets, of things of that nature. And then from the participant, from your employee's perspective, the employee doesn't want to hear you say that it's not your fault, it's the third party provider's fault. The employee wants to know, what is the employer going to do to bring back the employee's lost assets?
No, I think that's a great point. And I think that would apply to almost any service provider. Service providers, in most cases, are an extension, how I look at it, as an extension of the sponsor. And so you should be monitoring your service providers, including things for what are the cybersecurity policies at the provider, just like you would internally. So what are some of the things you can actually do to mitigate the risk of cybersecurity? Number one, and we just talked about this, I think we've hit it a couple times, understand your service provider policies and controls. One of the best places I know to start with that, at least the starting point, is what Danielle talked about with the SOC reports. They may or may not mention cybersecurity within those SOC reports, but it's a great starting point. If they don't address it, it's worth meeting with your service provider, understanding your agreements, as Renee said, and making sure you understand what policies they have in place. How do they plan to get data back and forth with you? Is a great place to start. I personally, for our retirement plan, I don't want to see a service provider sending any of our participant data over unsecured email. So it's questions like that, which leads to the next point, some sort of secure file transfer software for participant data. I would make sure anytime you're sending any information to any service provider, I would recommend you don't use just a standard email to send an Excel file. There's too much risk that email goes somewhere that it should not. As we talked about, verify the plan sponsor cybersecurity planning includes employee benefit plans. So we've talked about this a couple times as well. You may have a great cybersecurity process within your organization, but you should be asking, does that include the benefit plans? Are we factoring all that in? Because quite honestly, our benefit plans might be some of your biggest risk within your organization with all the data we're talking about. Another opportunity is SOC for Cybersecurity. This is a new service that the ICPA has begun promoting, and this is something your CPA can also come in and look at your organization's enterprise-wide cybersecurity risk management. So it's not necessarily testing all the cybersecurity and to make sure it's all working. It's more or less looking at all the things you have in place, making sure it covers all the things it should. So it's a good opportunity for to get a handle on what opportunities you might have to improve within your organization. And with that, I'm going to kick it over for a legal update to Renee.
So for the legal update portion, we're going to briefly discuss 4 changes that occurred in the employee benefits world in the last couple of months. And we're going to start with the first one with the Revenue Procedure 2019-19. And essentially with the IRS, in the past, if you had an issue with your retirement plan, for example, it wasn't up to date, compliant with the current law, or perhaps you weren't operating your retirement plan in accordance with the plan documents, then you would have to go to the IRS, file a VCP, say, mea culpa, this is what we did wrong, this is how we're going to fix it, and by the way, here's our check for our penalties and fees. And so recently what the IRS did is they've expanded their self-correction program, and actually they've significantly expanded their self-correction program, and they did it with 3 different areas. And the first area that they expanded was related to loans, because they're seeing a lot of plan failures related to loans. So with the self-correction program, all you do is you fix the problem, and you fix it in accordance with the IRS guidance, but you fix the problem. You don't have to tell the IRS. And I think everyone can agree that not having to tell the IRS that you made a mistake is a good thing. You don't want them to audit the rest of your plan, and you don't want to have to pay the fees. So with respect to the loans, one of the most common mistakes or errors that we see is with respect to defaulting on plan loans for the 401k. And it happens, and inevitably happens all the time. You have a participant who has a plan loan who defaults because perhaps the spouse is now unemployed, there's medical expenses, or let's be honest, it's Christmas time and they want to spend the money on presents and not paying back a loan to their 401k. So in the past, if the employer did not default the loan when the payment was missed, then you could have disqualified your plan, and you would have to go to the IRS and say mea culpa. But now the IRS says that you can actually self-correct that mistake. You can have the participant, the employee, just make a makeup payment to cure the default, or you can amortize the defaulted amount over the course of the remaining term of the loan, but you can actually fix it. And in doing so, it won't be considered taxable distribution to the employee as it would have in the past. So that's one of the things that you can now self-correct. Another thing that you can self-correct with respect to loans is the spousal consent. And a lot of HR people and a lot of companies completely forget about the spousal consent when they allow an employee or participant to take a loan, and I guess I should say third-party administrators forget. A lot of times third-party administrator may not know if your employee is actually married because of the lapse in the time between the time person was married and the time that they were actually notified, if they were ever notified. And now the IRS is like, okay, stop sending us paperwork because the spouse didn't consent. If the spouse didn't consent to the loan, go out and fix it. Put the document in your file and everybody move on. The third area with respect to loans that you can now self-correct is operational errors. And that actually falls with the second category as well. Operational errors are when your plan document says one thing, but you actually operate the plan in a different manner. So for example, with respect to loans, your document might say that you may only have one loan, a participant may only have one loan, and you actually allow the participants to have multiple loans because you've always allowed them to have multiple loans. Or for example, hardship. Perhaps the hardship box was inadvertently not checked on your adoption agreement, but you've always allowed hardships. With respect to those types of mistakes, you could retroactively amend your plan to correct them. And you can do this as long as your amendment to your plan is providing an additional benefit or option or feature to the employee. You can't take away anything by retroactively amending, but you can give them something by retroactively amending. The amendment has to be applicable to all participants. You can't just favor highly compensated employees, which I'm sure most of you would have realized that. And the amendment can't be contrary to law, which again, everyone listening to this would know that, but the IRS felt it necessary to make that a prong. And then the last thing that you can self-correct under this guidance is a failure to timely amend your plan. And in a few minutes, we're going to talk about the new hardship withdrawal rules. And in those rules, the procedures have to be in place at the beginning of the year, but you don't have to amend your plan to December 31st, 2021. And I promise you that someone is going to forget to amend their plan because you don't have to amend it for 2 years. It'll be on the back burner because everyone is conducting business and doing other things. But what the IRS says now is that if there is a required amendment to your plan and you accidentally forget to do it, that you can go back and amend your plan as long as you do it within 2 years of the end of the plan year in which the amendment should have been made. So the IRS is giving everyone a little bit of leeway here. So the next significant thing that has occurred with respect to multiple employer plans, and this was a DOL regulation. And under ERISA, an employer may maintain a plan, and an employer is defined as a person or entity that's directly acting as an employer or indirectly acting in the interest of an employer, and this includes a group or an association. The problem is nobody knows what that means because that's not defined further than that definition that I just gave you. So in the past, the DOL has come out and said, okay, let's talk about these associations and groups acting for an employer. And the DOL has allowed associations to actually sponsor retirement plans and allow members of their associations to adopt those retirement plans. And the reason why people want to do this is because having a retirement plan costs money. And if you have multiple employers pooling their assets together under one umbrella retirement plan, then you would theoretically get the benefit of the economies of scales. So it would be cheaper. You would have less forms to file. It would be easier administratively. And in the past, you've been allowed to join this association and have this one retirement plan covering all of the different member employers if there was a substantial business purpose unrelated to offering the benefits, if there was a formal organizational structure and the members actually controlled the activities, and then you had each member had an employee who was a participant, and there was a commonality of interest. And the commonality of interest was historically like the same trade, industry, line of business, or profession. So say, for example, if you're a manufacturer who belongs to the manufacturing association, then you're in the same trade and industry line of business. So the association could have a 401k plan, and then individual manufacturers who are members of the association could actually adopt the plan. The DOL has now this year expanded that. So the commonality of interest isn't just people with the same trade, industry, or line of business or profession. It's also those having a principal place of business in the same region. And the same region is within a state or it's a metropolitan area, even if the metropolitan area crosses state boundaries. But so the DOL has expanded who can be a member of an association. And you're thinking, so who does this help? This helps your Chamber of Commerce. So if you're a member of the Harrisburg Regional Chamber of Commerce, the Harrisburg Regional Chamber of Commerce can adopt or sponsor a plan to be adopted by its members, even though one member might be a car dealership and another member might be a law firm and another member might be an accounting firm. And so the DOL has actually expanded this, and again, in an effort to help save money for employers. If this looks familiar, it should. This is the same language that was from the 2018 this was the same language from the 2018 DOL Association Health Plan regulations that has recently been struck down. However, this applies to retirement plans, so we can, it's the regulation, so we can rely upon it. Next, in a similar note, professional employer organizations are also allowed to have these type of plans as long as it complies with the rules. The professional employer organizations are those, if you outsource your HR functions and you have a co-employment arrangement with the organization, then it's those organizations that actually can sponsor a plan that the individual clients can then join into.
Now, Renee, are you
Yes.
seeing much activity in this market with these multiple employer plans at this point? Are you seeing much opportunity? Are you getting a lot of questions?
I'm getting a lot of questions, not so much with the professional employer organizations, because a lot of people in this area don't necessarily outsource to that extent.
Okay.
They'll use leased employees, but they won't outsource to that extent. But a lot of people are asking about the multiple employer plans. More people are asking from the health side, and unfortunately, the health side you can't do right now because that law has been overturned.
Perfect. Thank you.
So the next one is the hardship withdrawal regulations that have been finalized, and there's required changes and optional changes. So the required changes are you're no longer allowed to suspend deferrals. Effective January 1st, 2020, if you have an employee who takes a hardship loan, you can't suspend their deferrals. If you have employees now with suspended deferrals, you can allow them to continue in suspension, but for new loans after January 1st, you can't.
Does that require a plan amendment, or is that how it works now? Okay.
So two things. One, it's how it works now. It is how it works now, but the IRS said that you have to amend your plan by December 31st, 2021, or your plan will not be in compliance. You have to amend your procedures by January 1st, or as of January 1st, 2020. Or if the IRS audits you, then you will have an issue.
So any sponsor on this webinar, if they've not already amended their plan and don't have plans to amend it for this, especially for hardships, it's something they're required to do. Okay.
Right. And actually before January 1st, you have to amend your procedures. Okay. But the plan which would go to would need your board's approval, you have a little bit more time to do that. The second thing under the hardship withdrawals that have changed is in the past, you could receive a hardship withdrawal for medical, educational, and funeral expenses of your spouse and children and dependents, and for funeral expenses for your parents. The IRS now says that you can actually get a hardship withdrawal for those expenses for your primary beneficiary. So not everyone has a spouse, or dependent, or child, or a parent. At least alive. And so now if you have a primary beneficiary of your plan who needs money for educational expenses, you can request a hardship withdrawal for that as long as you comply with the other parts of the reg. And the other new expense allowed for hardship withdrawals is expenses and losses as a result of a disaster in a FEMA designated area. And in the past, what has happened is there's been a disaster. FEMA is designated as a disaster area. And then a couple of months later, the IRS comes out and says, hey, look, you can get a hardship withdrawal for the expenses if you live or work there. The IRS is being proactive now. And they're saying proactively, if you live or work in a disaster area designated by FEMA, then you can get a hardship withdrawal for your expenses and losses. Also with hardship withdrawals, the last required change is that you can rely upon your participants' written representations. So all your participant needs to do is attest to the fact that there's been a hardship, there's no other available funding, and that this is what the hardship is. So unless you know otherwise, you can rely upon that writing.
That's tremendous. I think of the burden to provide documentation, especially on a plan sponsor or someone sitting in human resources to gather this documentation to support it. So if I'm hearing you correctly, that's no longer necessary. It's just a representation from
that is
the participant.
Correct. It's the participant's representation. Now, that being said, if you know that the participant If you know something and the representation is not accurate, then you can't
Yes,
rely upon
okay.
it. And with respect to the representation, the participant doesn't need to have a loan before receiving a hardship withdrawal unless that's required under your plan. And let's go to the optional changes. An optional change is you can require your employees to receive a loan before receiving a hardship withdrawal, but you don't have to. So however your plan handles that is the way that you should handle it when you receive the written representation. And also, you can amend your plan to allow distributions from the earnings on elective deferrals, the QNEX, QMAX, and the earnings upon that as well. And then lastly, the fourth major legal change recently has to do with retirement plans or electronic safe harbor rules. And currently what the rule is that it's an opt-in procedure. So if you have an employee who's wired at work and you have participants who opt to receive documents by electronic delivery, then you may deliver it electronically. The proposed rule, which is not valid right now, so you can't rely upon it because it's a proposed rule, will have it reversed. You can still rely upon that part, but it's going to be an opt-out procedure. So if you have a participant and you have a valid email, they have to opt out of receiving electronic delivery. Also, your email to your participants will now be notice and access, which is it's going to be an email. It's going to say, here's the document that we're posting, or this is what the document is. Here's the website address, and this is how you get a free paper copy if you want to elect paper delivery in the future. And then your participant would just go and either click through or cut and paste the website address to actually go and find the document. So you won't have to physically give the document to them anymore, which should save money. And then, so next.
So I think what we're going to do now is we're just going to end with going through a few recent cases so everyone knows kind of what's going on out there, what the DOL and the IRS are focused on, and where things could go wrong. And in this first case, CMG Vending Inc. Pension Trust Fund, a trustee was charged with stealing funds from the pension trust fund. And we're not talking about small dollars. Between 2010 and 2018, this trustee stole $369,000 from the fund in 52 separate withdrawals. And the one thing that we don't have here is that they also noted that the participants lost out on approximately $98,000 in interest on top of this $369,000. So we'll find out at the end of the year what he will be sentenced to. But my question for you, Dan, is how do you think this might have been prevented if you're looking at it from an internal control standpoint?
No, what's interesting when I hear this first case is I think each year we do this webinar and we try to pull recent cases that we see published out with the Department of Labor. And I feel like we consistently see something like this. And so for as long as we've been doing these types of webinars, we continue to see these types of cases, which means these things keep happening. And so I'll go back to some very basic things, just like we would talk about with any other client outside of benefit plans, is just segregation of duties. Obviously, if he was able to embezzle $368,000 in a span of 8 years, this was not a small plan by any stretch. Which tells me a plan that size had the ability to have enough people involved to segregate duties to make sure that he could not continue to do this for 8 years. So that's the first point to me, is making sure someone that's making decisions over when distributions or disbursements are leaving the plan, that there's some level of oversight of that. Along that same line, that segregation of duties is verification of withdrawals. So again, I think this just making sure you have the right people and enough people that are monitoring transactions. So whether you catch it on the front end, I would expect some report from the trustee, wherever the assets are held, or the custodian, is making its way to someone's desk to see what money is actually leaving the plan, and making sure you have some level of oversight of that and verification before it actually happens. And easy one, as we talked about segregation of duties again, having more than one approval. So making sure that once a disbursement's getting ready to leave the plan, that you're actually getting a secondary approval. It's not just one person controlling all these assets.
Okay. So in the next case, Techniform Industries Inc. 401k plan, We kind of touched upon this earlier as far as late remittances are concerned. But in this case, fiduciaries were accused of violating ERISA by failing to remit contributions from the employee's pay into and keeping it in a corporate account. The fiduciaries are required to restore $23,000 and penalties of $4,700. And the one thing I want to point out about this is in no way, shape, or form are these contributions anything to do with the company. They are not company assets. These are employee funds and employee contributions, and they should be remitted to the 401k plan as soon as administratively possible. I don't know if Renee or Dan, you have anything to add.
Right. So because I did see this, something else that the court is requiring, or the DOL is requiring, is that they terminate the 401k plan. So all of the participants in the plan are now required to actually roll their money over into an IRA. But it's, and you think about it, and I could see where a lot of employers just wouldn't think that what they've done was wrong.
Right.
I mean, they withheld the money from the checks and they left it in their account. They just failed to remit the contributions. And I'm sure they held it. I mean, the DOL wouldn't have taken this position if there weren't something else going
Right.
on behind the scenes. But this could theoretically happen to anyone whose employee quits, and you need to go back and make sure that the money that you withheld from the payroll was actually put into the accounts.
No, and when I look at this one, Danielle and I spoke before the presentation. How do you prevent something like this? When I see the folks that were involved in this, when you're talking to the president and CEO, it tells me it's probably a smaller company. So they have key roles in the plan amongst many other things. I don't know how many things you could actually do to prevent this. It wasn't like it was running through other people within the organization. This more or less, I look at this more as not necessarily participant responsibility, but I'd make a recommendation for everybody that's on the webinar. If you're participants in a plan, that you're doing some level of monitoring of your own account, because again, we're talking a lot of service providers, we're talking a lot of activity in the plan. So looking at your statements, making sure when you get that statement in the mail or the email that you're looking at the statement and making sure your account looks about right. I'm not saying look at everything to the penny, but there is an opportunity for you to look at your own statements and maybe see, hey, wait a minute, I know I have money taken on my paycheck the past 6 months, but I don't see any contributions going into the plan. And why I don't think that's common, I think it's worth a few minutes every couple months to make sure you're monitoring your own accounts.
Okay, and we'll just go through this case briefly as well. Sweda versus the University of Pennsylvania. And this is the type of case that I think I'm seeing more and more of. And essentially what happened here is what they're saying is the university's retirement plan failed to look into fees, and they ended up paying what they thought was an overpayment of fees for investment and plan administration. And in addition to that, they failed to timely remove underperforming investments from the plan's assets. And I feel like every time I'm looking for cases, these are the types of cases that are really starting to pop up more and more commonly. So Dan and Renee, I don't know if you have anything to comment on
No, I
this.
see the same thing. I mean, you can go, just like I mentioned, you can go back a couple of years and you still see these cases. And I think participants are getting more educated and they're seeing various levels of, you might have what looks to be the same exact mutual fund in 5 different plans, but it's a different class of mutual fund. It has different expenses, and participants are becoming aware of this type of information and realizing, hey, that small percentage difference in the expense that I paid really affected the outcome of my retirement. I mean, these fees do add up, and if they're not being monitored and being taken seriously, it can impact what your retirement plan looks like. And so I don't expect this activity to decrease anytime soon.
Okay. And then the last couple of cases that I'll just mention so that everyone is aware that this is out there is Prudential and Goldman Sachs are finding themselves in the same situation where they're being accused of putting their own interests ahead of the participants by choosing their own investment products for the pension plans to invest in. So as you can see, there's Prudential, there's Goldman Sachs. Obviously, we're probably going to continue to see these types of conflict of interest cases going forward.
This leads us to our last polling question of the day. So we've talked about, we've had these webinars for a couple years, and a few years ago, we've done live benefit plan seminars where we bring in various service providers, such as McNees and other plan advisors to talk to our audience. So we'd just like to know, for those on this webinar, if you would consider attending a live seminar if we did, I'll say, a 3-hour seminar one day during 2020 with some of the same information, but maybe in a little bit more detail. Would you consider attending? And we'll give you a minute to answer that last question. Looks like we have our results. And most of you said yes, so that is something we will look at for 2020. So keep that in mind as we're sending some materials out from our firm, and look for additional educational opportunities. And any feedback at the end of this seminar, we'd really appreciate any feedback as far as topics. Maybe you didn't hear enough of something you wanted, but if you want to hear something more, a new topic, by all means, please present that to us, and we'll be sure to include it. And with that, I just want to go quickly this last side. Obviously, a lot of folks on this call are audit clients of ours, so you obviously know we do audits of 401k plans, DB plans, health and welfare plans, and other types of plans. But we also regularly help our clients with corrections, VFCP applications, data analysis and extraction. So if you have a plan with a plan compensation issue and you're trying to figure out how you're going to go back 3 years and dig through all your payroll to make a correction or to get that information, we've assisted with that. SOC for cybersecurity. We also do customized training with our plan sponsors. If there's something you want, maybe your committee to know more about, or some members of your HR department to be a little bit more familiar with the plan. If you're going through an audit for the first time, we're happy to do those things for you as well. And with that, that concludes our presentation. We thank everyone for joining us today.
Thank you once again for joining us for this webinar recap produced by McKonly Asbury. We hope you join us for our future webinars. You can stay connected to us and learn more about all of our upcoming events by visiting us online at macpas.com. Thanks again and have a great day.